Drilling fluids touch just about everything in the drilling process. We're here to deconstruct the drilling process and drilling fluid concepts to provide a deeper understanding of our industry. In each episode, we'll share information, talk to interesting people, and maybe share a few stories along the way. Welcome to the Flowline, a production of AES Drilling Fluids, brought to you by Matt Offenbacher and Justin Gauthier.
Hey everybody, welcome back to another episode of the Flowline. Now that Matt and I got our giggles out, again, I have to bring it up just because I think it's hilarious. Unless you've lived under a rock for the last 2 years, obviously you know AI is just taken off in all kinds of different directions. One of them is being video making, which we actually use to here at AES as part of our marketing campaign. We have some great videos on LinkedIn, but also more recently, Sora released their app, and I don't think everyone has access to it, but there's a lot of people who have been diving into making their own like short clips that look insanely real. And so Matt showed me a few that I just couldn't stop laughing, and just taking crazy different ideas and splashing them together to make these real life videos. It is the funniest yet sort of like palm to face thing. It's like, this is where we're at in the world of AI, is just making like goofy videos. And yeah, Matt, I mean, what's your take on the whole like AI and video making thing? Like, obviously it's used in good ways, but stuff like we were watching was just completely like degenerate.
I mean, this is the thing I'm just curious about is, I mean, like every technology, right? Like there's a good use and there's whatever else. But I feel like there's just this aspect of the internet where, you know, it's like even after a presidential debate or whatever, I'm more interested in like what goofy memes come of it, right, sometimes than like the substance of the conversation.
The internet always takes over and wins.
Yeah, and I don't know if that says more about me or what, but it's amusing to see how people have fun with it. But It's also one of the you know, the questions also with AI, and you see these questions like, okay, what are the real use cases? Like, where does it actually generate something outside of entertainment?
Yeah.
And I mean, obviously they're out there, but the like ones I can see as far as uses with the latest release of Sora, I think Sora 2, is weird stuff. And I mean, it's like funny and it's entertaining, but it's like, how much time did you spend prompting this?
Well,
you know?
and then you look at it, you know, as energy folks, you look at the amount of compute and energy it takes to make something like we just watched, and you know, people are pouring money into making sure that can happen.
Yeah.
But then again, you look at it sort of down the road, and it's like, is entertainment as we know it just completely getting flipped over on its head between music and you know, Hollywood and all that? In 5 years from now, I couldn't even imagine some of the stuff we'll be watching that's somewhat AI generated. And so anyway, I just thought that was kind of funny. And speaking of videos, that was leading into a segue, one that wasn't AI generated. And if you're watching the video, I think I have an eyelash in my eye, but anyway, moving along. We just released the sort of promo video for our Tenaha facility.
Yes.
Which is awesome. It is up and running and servicing rigs, and some of the flyover shots, and really just to be able to see the scale and size and really the operation out there is impressive. And so, yeah, I just wanted to kind of throw that in there. If you follow or connected with AES on LinkedIn, you likely saw it, but if you haven't, just give it a look. Yeah, I think it's a great, impressive video, and you know, it describes sort of the capacity and sort of the abilities that we have out there. And so I just thought that'd be neat to throw in there. And we didn't even have to use AI. It's real life. You know, it's organic, if you will.
Ooh, and I think the one thing that's cool is if you look at all of our mud plants, I mean, they're all a little bit different, but you'll notice that like our mixing pits are all the same, like 500 barrel round mixing pits. So we make those all the same across all of our fleet of facilities. And we have a construction crew that knows how to build them quickly and that sort of thing. And so the one cool thing about Tenaha, or not one, but one of the other cool things about Tenaha is that you can tell a customer like, no, really, like it will be up in 6 months. And when we say, oh, it's not like this was authorized and it's part of a 3-year expansion plan. These things go up very quickly. The pole barn, some of these other things, it's just like, no, these guys have done this in 8 other places,
Yeah.
and they're just doing it again.
Yeah.
So there's a lot of consistency, which helps build with reliability. We know what works, and we know what works with other things. So yeah, it's a cool thing for just what they're able to put together, and the Bayrite terminal and all that other stuff. So.
Yeah, no, it's been neat because a lot of the areas that we've grown into, we've actually built our own infrastructure and not just, bought someone else's and then made it work for us. So, tailoring it to the basin, obviously, because every basin requires a little bit something different. But at the end of the day, we kind of have a blueprint for success on infrastructure in new basins. We've been doing it forever, since, probably the 2006, 7, and then on. So it's been cool to see. And now there's just new basins that we continue to go into. And so big shout out to the operations team, Nate Castaneda and the group, Lonnie. We're full steam ahead out there. It's been fun and continues to grow. But with that being said, I usually do this announcement at the end, but I just wanted to throw this out there. Obviously, if you look at the number of, I don't know what episode this will be, but we've done a lot of episodes. And so a lot of times we look to the listeners for topics and ideas for shows. So if you're listening and you have a question or a thought or even an episode you want us to elaborate on, reach out to us on LinkedIn or the Flowline podcast at aesfluids.com if you'd like to do email. Just connect and share some ideas or a topic that you'd like us to cover. And then just be sure to connect with the AES page on LinkedIn, Matt and I. Check out the tech tips on YouTube. We might have one coming down the pipeline on lubricity, it sounds like.
Yep.
So just continue to educate the audience and anyone interested, and especially customers that like to learn from us too. Always important. But with that said, we're going to shift away from more of a technical topic, and so talk a little bit more just on the sort of the overall oil and gas landscape, sort of macro level stuff. Matt and I are fans of a gentleman by the name of Arjun Murti. We've referenced his name before. He's got a Substack called Super Spiked. He also has a podcast and a video series that goes along with it all. And so Matt had brought it up and actually shared some information with our group and thought it'd be good to talk about. So Matt, I'll kind of let you elaborate on sort of the idea, and then we can kind of just rip on it for a bit.
Yeah, I think what really captured my attention is, one, I mean, there's a lot of analysts out there, but what I really have admired recently is Arjun Murti has said, hey, I had this sort of viewpoint, and I think I'm wrong. And a lot of times they tend to skip over the parts where they're wrong and just talk about why they were mostly right.
Yeah.
But he sort of reflects on it in the last couple of Substack posts, and there's a lot of kind of narrative and arguments that he seems to be leaning into that have made him skeptical of what other people are saying, and basically said, I believed something, I don't believe it anymore, and now I don't believe these other things that I'm being told because of all of this.
Yeah.
A big part of it is, or the general argument he believes is that as tough as it's been out there, that we are pretty much in the trough, and he's a lot more optimistic that we're going to get out of it soon, shy of what he calls, kind of like shoulder season, which is, the next couple of months. And so he shared some figures and some comments, and I thought they might be worth just kind of ripping on, as you say.
Yeah. So I guess to kind of set the stage, Matt, do we want to provide some context on sort of like the cycle of when we say trough, kind of where we were, a few years back? Obviously things slowed down. Can you kind of like provide a little backstory as to where we were and now where we're at and where we kind of think we're heading out of?
Yeah, I mean, the pandemic sort of jacked everything up, I think, as far as anybody's like linear train of thought. But as oil recovered from negative $37 a barrel or what have you, we did see a reasonable recovery at one point, and then it became a question of both. And at that time, OPEC made some pretty aggressive cuts, which gave everybody confidence that supply would be limited. And production has recovered, and OPEC has been pretty aggressive in unwinding those cuts, bringing more oil to market, and with WTI in the low 60s. The big question has been, well, gee, if they keep bringing oil in the market, like how low is it going to get? Like this, and in the middle of all these things, we've got sort of a bunch of, competing noise. We have, prices are low, and part of it is these shale producers just can't control themselves. They're producing a lot more. Mm-hmm. A factor as far as how some of that's reported is that natural gas liquids are reported with oil, and it's not oil.
Right.
The IEA, which we talked about in a different episode, was very bearish, like, hey, we don't need to look for any more oil. We got plenty, and we're going to wind down hydrocarbon consumption anyways. Mm-hmm. And so they were giving their demand forecasts. OPEC was giving theirs, and the argument was OPEC, they're sort of biased because they want oil prices to be, or they believe oil demand's much higher than anybody seems to agree with. And the other question was, okay, oil's really cheap, and they keep unwinding these cuts, but where's it all going if the price hasn't plummeted? And one of the current beliefs, of course, is that a lot of that's going to China. They have a lot of storage capacity. They're, as a communist country, they can make these decisions to say, hey, we're buyers, let's get it stored up before prices go up, that kind of thing. But they were taking away all the capacity that was being made available, and there's not a great way to track if special agreements were made or anything like that. Mm-hmm. So with all those things, the reflection was Arjun Murti is basically like, I don't actually believe that narrative is all of it. Mm-hmm. He thinks OPEC was more right than the IEA, which I think OPEC diverged not only from the IEA, but from a lot of other consensus forecasts. And, in light of those things, he anticipates that, the end of the decade will have pretty strong pricing recovery.
Right. And so really with that, and if you look at where we're at now, you can feel it on the ground here with, kind of when things are close to the bottom and in the trough, a lot of, especially, and you see this in the headlines, right? Like there's a lot of cost cutting, unfortunately, a lot of, by that, I mean, a lot of, say like stuff that's public, like Conoco laying off 25%, the Hess Chevron deal, 70% of Hess just gets, asked to leave. And so you're seeing, a lot of the big oilfield service companies announce layoffs. But they're going to this sort of, cost savings mode. Operators are looking at really profitability, making sure that, they can set themselves up to have a strong cash flow to then hopefully reinvest to go. 'Cause it looks like, most of oil and gas companies are having to fund themselves. The public markets, if, that kind of leads into the weighting average of the S&P, which we'll kind of get into. But, a lot of the oil and gas companies are having to fund any bit of new growth, which there's not very much of that obviously going on. There's not a lot of people talking about growing production. But with that being said, we're kind of at this point, it's like, okay, we're going to set ourselves up for success and hopefully capture the upside, which, talking to, I was at a conference, and I think I mentioned this actually, is it kind of plays into it. There was a gentleman from Barclays talking about, a good 10 years of slow but steady recovery and sort of long-term outlook of positivity, which sort of aligns with Arjun's sort of take on, demand and sort of the long-term aspect of pricing going up. But, I mentioned a little bit, but Matt, can you kind of talk a little bit about the how much energy actually takes up the S&P? Because I think it's kind of neat to think about relative to what it used to be.
Yeah. So part of his argument is he's like, look, energy stocks are cheap. Oil and gas stocks are on the very, very low end, and so as a weighting of the overall S&P, they're down to about 3% from a market cap perspective. Mm-hmm. And historically, it's more like 8 to 10%. And so from the perspective of, okay, they're paying dividends, they're doing the fiscal discipline, they're not out drilling themselves, all that stuff is happening. His argument is, look, they're more or less undervalued, and kind of looking at history, these things are probably closer to the upswing. Like he's sort of saying this is likely the bottom of the trough. And I think it's interesting. I never thought of that breakdown nearly as much. Although our friend Josh Young, he's brought this up as well. That like this is the smallest of overall. Like think of how important and capital intensive and big these oil and gas companies can be, and what a small component they are currently of the overall market when they really haven't been in this position in a very long time.
Yeah.
An argument could be made, reasonably so, I think, that they're going to regain some of that share. And of course, timing is everything with these investment people and that kind of thing. But for us, I guess it does give a little bit of maybe some hope. It's like, okay, we know it's really tough out there. We're very aware of that, and at the same time that maybe this is the bottom, and we start seeing a healthier market and reasons to feel a little better, I guess.
Right. Yeah. So do you see that sort of on the service side as well? I mean, the observations that, because obviously we live in the service world. Do you see, generally speaking, a lot of the service companies kind of following the same, I guess, strategy, if you will? Not necessarily us, but just kind of broadly speaking.
I mean, I think it's harder for service companies, and once again, this is just my opinion, and I think Spears talked about this a little bit on LinkedIn the other day. There's an element of this where he's, the thing with an oil and gas company is they, they've got assets in the ground, they can sort of self-finance things. So there's even, he was pointing out, like, you had these big mergers and now you're having divestments. You got private equity to come pick up, and so for every company that gets bought, you've probably got a startup, at least one that falls behind it. Mm-hmm. And the thing we see with or you can see with privately helds is if they pick up a rig, they're trying to build production to build up the value of their outfit. They may be a little differently motivated than a publicly traded company as far as their drilling activity, which could be good for service people in some cases. But the flip side of it from a service company perspective is, we have to go to the markets to borrow money and that sort of thing. And we're very much dependent on the volume of work that's available. And so I think, maybe that puts pressure on consolidation. Spears would argue that there's a lot of consolidation needed in the directional market. Yeah. But I also think it's really hard because it's a very low barrier to entry. With respect to, you have some decent people and you rent the tools, you don't develop your own. Yeah. You can make it work. So, I don't know, but I think as a service provider, it always feels like we're the stepchildren. We're always feeling sorry for ourselves.
Yeah, and I think when you kind of look at sort of like, at the end of the day, businesses are in business to make money. But I think there's no more tolerance for inefficiencies in the oil and gas, oil field service space, and even obviously the E&P side. And so I think for long-term health, we're kind of set up better to capture these runs. Like you look at 2010 through 2020, everyone was outspending themselves for growth's sake over creating value. So I'm excited as an industry to go through another hopefully long upcycle without being disciplined or with being disciplined. Yeah. You know what I mean? Like how much better we'll come out the other end, and we'll be able to not maybe absorb the volatility a little better than go through these massive swings of, hire a bunch of people, lay a bunch of people off. And so I'm optimistic that we're going to go through this one with a lot, just a better strategy from like a capital discipline side of things. I mean, what do you think on that?
I think what you're telling me kind of reminds me of during the pandemic when we had customers say, look, we're keeping these drill teams together. Like, we're keeping our best. We're Like, we're hunkering down. It's really tough, but we're going to keep our best and brightest. And we're going to sort of march forward. And it was really interesting because a lot of customers said, I can't afford to not have the best, which was, we expected that everybody was just going to demand that, like, if you want to not lose everything, you've got to be the cheapest thing out there. And instead, what you had was very value and performance oriented. Like, I will pay for the things that make me the most successful, and I expect you to show me what that looks like. But I'm not just going to chase the cheapest thing out there.
Yeah.
And so we were able to have some very, like, elevated conversations. And I think, I mean, that gives me reasons for hope now of the way we're, you know, a lot of the things we've done with data science recently, and a lot of the things that are sort of on the roadmap that we see for next year. I think, one, we've had, like, I don't know what you call it. It hasn't been this crazy full bore, like, just get hands on rigs and I need heartbeats, not brains. And like, it's been a very strategic approach.
Yeah.
And in light of that, I think as those things have matured or get ready to help serve our customers, they're in a good place to, like, fit correctly. And so hopefully that means good things for our business.
Yeah.
But I do think that, you know, it goes hand in hand with some disciplined engineering and some other things that I think, you know, you're alluding to, where, like, people are being very intentional about how they approach performance and efficiencies and that sort of thing.
Yeah, and I'm not even going to pretend like I'm a finance guy, but Arjun makes mention of some key metrics on profitability, and ultimately, it's as an industry, it feels like we're getting more value out of the money we spend, right? And that's a good thing. And he mentions Croaky, and again, I want to get into all this, but ultimately, it's like you invest this much, and how much return are you getting to measure profitability? And it's kind of neat to see just sort of the graphs on that. But even us, you look at, you know, the money we spend, and, you know, and then you know, the money we spend putting it into things like the analytics platform and some other things that we're doing to get more value out of what we already are doing to then service the customers better. And so it's like, I think that all plays into, like, just better health as we move into this next sort of cycle, or as we move into where we're going. Pivoting a little bit, talk about the oil glut narrative versus, you know, what's happening versus, like, the reality versus what the narrative has been, because I think that's an interesting take. There's a pretty big spread of what Arjun thinks the oversupply is relative to what, like, the narrative is.
Yeah, I mean, you're seeing some analysts saying that we could be oversupplied by, like, 4 to 6 million barrels by the end of the year per day,
which means down on oil price.
Yes, aggressively so. And I would say, I can't remember if it was he who said it, but somebody, like, there was an argument, well, everybody thinks there's an oversupply, it's just the degree of how much. But most of these commentators seem to think it's quite large. And why is OPEC continuing to, like, unwind their cuts? And, you know, I don't know. I don't know. But but Arjun Murti would seems to be arguing. He's like, I don't think it's as significant as people think, and the OPEC's oil demand estimates seem to be a lot closer to reality, or that seems to be the direction he's headed. I mean, it's well worth reading his work. But that's just interesting to me because it seems to go a little bit against some of the consensus. But the other argument is like, you know, some would argue, oh, well, they want to lower oil prices to punish unconventional producers so that they can gain market share. But we've been down this road before, and it turns out that they just, like, you know, some guys would go bankrupt and then they'd show up in another form. Like, the oil's still in the ground, and it's still gettable. So when the price comes back up, so does the production.
Right.
And, you know, I've heard another argument that as they unwind these cuts, part of it is that it will show who can actually produce what they're allocated. So if you start seeing that, hey, country X is allocated this many barrels, but they didn't produce that, it means they can't produce anymore. And so it sort of shows like, hey, this is all we can do among the mix of quotas.
Right.
So then that may be like a global signal, like, hey, that's if demand goes up at all, like, we're in a deficit.
Right. Well,
So-
that's where he says, I think he references the risk is upside, not downside. Once
Yeah.
everyone realizes there's not actually this much glut in the system, which, again, if one believes that and it holds true, then it's a good signal for us, and it means better commodity pricing and hopefully more activity. Matt, was there anything else in that article that kind of, I guess, just you found interesting? I think we covered a good sort of, again, very generically, but he goes into much greater detail. Was there anything else, sort of a key topic in there that you remember?
I mean, I think I thought it was interesting. I think it's worth listening to a lot of different voices on these things, and it's kind of one of those, when you start seeing consensus, does that mean everybody's right or everybody's just following everybody else? I mean, look, as much as the next guy, I'm looking for reasons to be optimistic.
Right. And
so to some degree, I hope what he's saying is accurate or turns out to be true. But it's one of those, it certainly gives food for thought and raises the question of what don't we know? And, grand scheme of things, I think we all just want some healthy oil prices so that we're not seeing these painful headcount reductions. And, I think even if you're one of the fortunate ones who, gets to keep their job, you feel you're heartbroken at the people who don't. It affects everybody. And I think even, it gets people in preservation mode. They start to think a little differently, and it's always nice to have a little optimism and be ready to step out and say, okay, we're going to flex. Like we're doing some good engineering here. I'm not going to do something for fear of failing, but because I want to be as successful as possible.
Yeah.
So that was sort of my takeaway. I thought listeners might enjoy it, and we'll see what the next few months hold.
Yeah, no, it's always a good conversation, super interesting. And again, for those that are listening, it's again Arjun, Arjun Murti, Murti. Just Google his name and then Super Spiked, and you can follow the rest. But it's, again, they're short articles, they're easy to read. As someone who's spent years as a market research analyst, they tend to get pretty heavy in the jargon, but even for a dumb roughneck like myself, I can tend to understand most of it. So anyway, I joking, but nonetheless, it really is for just kind of anyone who's interested in that stuff can actually learn, read it, and understand it, which I can appreciate. He makes it digestible for everyone. So but anyways, if you have any thoughts about it, or you have any crystal balls that you'd like to throw our way and share with us, we'd be happy to read them and just kind of listen into all our solid listener base. With that being said, I already did the announcement, so I'm kind of getting thrown off here, but anything else, Matt, before we close out?
That's all I got.
All right, everyone, take care for now. Cheers.
Take care.
Thanks for listening. Please tune in next week for another exciting episode of the Flowline. And remember, may your returns always be full and your trips always smooth. Views expressed in this program belong to participants and not their employees. The program is for informational purposes only and cannot take the place of seeking professional advice. Copyright AES Drilling Fluids.